This is the Note Closers Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. I'm Scott Carson, and release the Kraken. Today's episode is going to be about something that came out on Friday. It's a news article that Housing Wire put out there about how Flagstar Bank is rolling out 0% financing loans to credit-challenged borrowers. Now, is this a good thing or is this the bad thing? I sent an email out yesterday and actually just it went out early this morning to our database about how this is a very significant domino, all right? Very big domino when you have banks starting to do 0% financing again to credit-challenged borrowers. Plus, they're also providing, get this, they're also providing down payment assistance for free, where Flagstar is gifting either up to $3,500 down towards an FHA loan or $3,500 down payment, and then $1099 in the borrowers where they don't have to pay it back, but they do get taxed on it at the end of the year. Now, why is this so significant? Well, a couple of things. One, Flagstar, who lends in a variety of states, just so you know. So Flagstar lends in Michigan, and they're doing this program initially in 18 counties around where they're located in Michigan, but Flagstar has a lending presence in Arizona, California, Georgia, Indiana, Kentucky, and Nevada besides just Detroit. What's this mean? Well, if they're lending out in just there locally, it's probably a pilot program that I'm willing to bet they're going to roll out across their whole footprint, okay? Now, a couple things from the article that come out. There's no obligation for the borrowers to qualify to repay the down payment. FICO score is going to be in the 640 range, which is not the greatest. It's not the worst, but it also is not the greatest, okay? If I believe on here, let me look at more in the article is saying here. What's funny is that they've done roughly, the values of these homes can't exceed $120,000 in value. So they're going to be $120,000 or less in value. I mean, it's not hard to find in a lot of areas in Michigan. That's not bashing Michigan counties, but the biggest thing is that they've done about $1 million. If I remember on the article here, I'm just pulling it up real fast. Of course, they interviewed people for the article that hadn't bought a home before and now can afford it, and their mortgage payment is half of what their rent is. The interest rates are somewhere between 4 to 4.6%, which is great. There's nothing wrong with that, okay? It's just that this is not a good thing because you're already seeing other banks that are jumping on board. A couple other banks they're lending. Fifth Third out of Cincinnati is doing the same thing. Launched a program last year. Probably gets up to 3% of the home purchase, maximum $3,600 to qualifying borrowers. Let's see here. Fifth Third is lending in Michigan, Indiana, Illinois, Kentucky, Tennessee, Ohio, West Virginia, North Carolina, Georgia, or Florida. So you're starting to see this stuff creep out across the country. Almost kind of like, I hate to say this, but kind of like the plague. And I don't mean this in a bad way because, yes, does it mean good stuff for us? It does mean good stuff for us if we're in the note game because you have people getting mortgages that can't afford. They shouldn't be able to afford it. If they can't afford a down payment of $3,500, honestly, they should not be in a home. It's just, it is what it is. We already have a low enough savings rate across the country. And I don't want to say that Fifth Thirds or Flagstar is praying, but they're literally looking to capitalize and boost their bottom line. Why are they doing that? Well, they're going to get these loans. They're going to make some more loans. They're going to package them up. They're going to boost it off and sell it off as part of their securitization package. Okay? That happens all the time with banks. They're just being greedy. And what's going to end up happening, all right, what's going to end up happening is they're going to end up, these are going to be the higher default rates. It's going to boost the default rates across the board. Now, it's a good thing for us as note investors. It means more inventory going forward. So I'm not trying to sound Debbie Downers because it is a positive thing. But financially speaking, as a whole, it is not a good thing for these borrowers. These people should not be in homes. If you want to think of as an economic speaking here, and you're never going to find a one-armed economist who's say, on the one hand you have this, but on the other hand you have this, and that's what I feel like I'm doing. Another lender who's lending on this 0% financing stuff is United Wholesale Mortgage, okay? But they don't, well, the one thing about United Wholesale doesn't include the gifting of the down payment, okay? But they are doing 100% financing. What's crazy is that these lenders are just the tip of the iceberg. It's just the first card in a house of cards finance game that we're going to see history repeat itself, okay? You're going to see these lenders start to roll it out across their different states, which is a sizable chunk of the country already if you start figuring those states out, all right? You're also going to see default rates go up in those areas, all right, because of these programs. So what you need to do is wait around 6 to 12 months and start seeing, I guarantee, some of these things will start, not only will they start sweeping across the country as other lenders get into it, as other lenders are standing by waiting, okay, you are going to see more things like this happen as more banks become greedy for profits to take advantage of the increasing property values that are going on to try to take advantage and be more profitable. Do we have any questions so far from anybody? Any comments? No? Okay. So the big thing to keep in mind is you can check out this article at housingwire.com. And I believe somewhere, I think I read in the article somewhere that the lenders have only done about $1 million in gifting. Well, $1 million in gifting at $3,000, that's about 300 homes. They've written about 300 loans on that, okay? That's $1 million. It's not a huge lending portfolio for you to keep this in mind, but it's just the tip of the iceberg is what I'm trying to get at. You're going to see this spread out more. You're going to see them start to drop the values as they're attracting the clients. They may go from a 640 to 620. Trust me, it's in the works. How do I know this? Because history repeats itself. When I was a mortgage banker, a mortgage broker, we would see this where lenders would come in and lenders would spring up to take advantage of opportunities because a lot of people keep thinking things are going to go up, and that's not always the case. If you're a traditional real estate investor right now and your property is accelerated, I would not be going and refinancing to pull all that equity out unless you plan on selling the house, all right? But most of the time, the refinances have a prepayment penalty of 2 points in there if you sell within 2 years. Now, for me, if I had a lot of real estate that had appreciated that actually owned the real estate, not the notes, I would do a refinance or just sell the property as best I could, okay? Just get the property sold, pull your cash out and hold on to it. Because I guarantee it, in the next 12, 24 months when these markets start to go south again, or default rates start to go up on these programs or other programs the banks have, it's going to lead to more inventory for us. And you're going to start seeing the dip again. And it's going to be like a wave. You have a drop in Michigan, and it's going to spread across the country. What's really discerning is if one of these banks does roll it out completely across their platform, if Flagstar really does roll it to Arizona, Nevada, and so in those states, yes, you're going to have a lot of people buying houses that they probably can't afford. It's overpriced houses. And you're going to have the same thing, somebody buying a house for 300 or 400 grand, putting nothing down, when it's really only probably worth a $150,000 to $200,000 value. Okay, it is an interesting time frame to be doing this. But what is going to happen? These kind of loan programs are going to feed product for the next 3 to 5 years to note investors like myself and those that are watching out there or listening on the podcast. So, always makes for an interesting time frame. Always funny seeing comments come back. What's it up to you to decide or to comment on banking practices? I'm like, listen, dude, I've been there, been on both sides. I was once the guy that's helping originate the stuff as far as doing loans, because that was, hey, if the bank was willing to pay me and then we do that, who's not going to make money on that? But I've also been on the other side where we're buying stuff and people are getting upset because they're getting foreclosed or evicted, but they have no skin in the game. When you make a loan and a borrower can buy a house with no skin in the game, no down payment, there's no motivation for them to stay in the property. There's no motivation for them once they go default. Why should I pay? I don't have anything in the game. I'll just move out. I'll just go rent a place. And you're going to see that happen as well. So questions or comments from anybody that's either watching live on Facebook?
Todd Las Pierre says, here we go again.
Here I go again on my own, going down the lonely road I've ever known. Sorry, Greg, I didn't mean to make your ears bleed there. So let's talk about some of the implications of this. Well, you're going to have, we did some basic economic numbers 2 weeks ago on the Note Night in America webinar, talking about how loan officers are increasing. The number of originators are increasing across the country. And you're going to see a lot more that can dive into this. You're going to start seeing the billboards popping up in more places than one about being able to buy a home with $500 down or $1,500 down. We've already starting to see this stuff. But when you start seeing in states 7, 8, 9, 10 states where it starts to become, especially when you have lenders lending in Michigan and Ohio and Indiana, Illinois, those are the Rust Belt states. You know, median home price in there is well below what it is in Texas, especially California, Florida. But you have people getting into homes that really don't have the financial savvy. And I'm not calling them stupid. It's just they don't teach finance anymore. They don't teach budgeting. They don't teach balancing the checkbook. They don't teach all the things that come with home ownership, because yes, your mortgage payment, especially if you're buying a new home. Let's talk about tax shock really fast, because that happens to a lot of new home buyers. All right. A house gets built in a development. For 1 year, it's taxed. You know, the first year it's taxed off of just lot values. You buy the house, you get in, you're excited. Oh, you budget. Oh, yeah, I can budget this. The taxes are this much. Well, in year 2, the property gets reevaluated for not only the lot, but the structure on top of it. So your tax bills will quadruple based on oftentimes because it's improved. Now your payment no longer fits into your budget. All right. Now this happens just on new builds. If you're buying an existing property, they've got the tax basis in place, fine. Okay. But we see a lot of that happen. People default in new housing communities because the taxes go up, and now they were just budgeting for their mortgage payment and insurance and low taxes. All right. Now they're in default. Now they're a default in the first 12 months or 6 months, depending on when that tax VAT comes through. Okay. That's not a good thing. If you have zero skin in the game from a borrower, you are very likely to default at some point. The more you put down coming from the mortgage side and the financial advisor side, the better off you're going to be. Having zero down, zero skin in the game is not a good thing. It's a bad equation with no real answer to it for success in the long run. Now, are you going to have a few situations where people, yes, they're going to afford it because they're supposed to be paying $800 a month in rent. Now they're paying $450. Yes, but there are so many other things that go along with a house in maintenance and HOA fees and other things. Furnishing. A lot of people go out and spend money on furnishing and forget that, oh, hey, I got to pay a mortgage payment. They just don't seem to get the aspect of that. In some cases, yes, it's a good thing, but in overall long term, honestly, it is not a good thing. Okay? It's not a good thing, but it is a good thing for us note investors. We may not see something immediately happen now, but in 6 to 12 months, I'm willing to bet. If Flagstar can't sell these things off, or United Wholesale Mortgage, or Fifth Third can't sell them off fast enough, you're going to see some good things. We've got a question.
Yeah, Tala Pierre says, is there any information on the gross income to payment ratios they're using to approve these loans?
So one of the things that you have to look at is usually mortgage brokers or banks aren't going to go above a 38% debt to income ratio. What does that mean? All right. Well, they're going to take your debts, what you got to pay monthly, all right, and divide that by your income monthly. So if I'll give you an example. If your debts are $400 a month and you're only making $1,600 a month, that would be a 25% debt to income ratio. They don't want you to be above 38. Usually a 38 to 41, 43% ratio. What they mean by that? 38% in the front end, 43% in the back end. You can't be above 38 now, and they don't want you to see 43% once you've bought the loan and restructured your payments and that stuff. Okay? So that's very easy to take a look at. One of the things, the comments in here, if I remember correctly, the annual income is going to range basically from $35,000 to $62,000 for these borrowers who are going to qualify for the 0% down and the borrower assistance. Okay. Now, borrower assistance program has been around for a while. A lot of cities have done things like that. Back years ago, when I bought our first house, when I bought my first house, I still had to bring some money to the table. I had to bring close to $5,000 in closing costs and things like that, but we got 100% financing. We had an 80-20 mortgage, an 80% first and a 20% second. One was with Chase or Wells Fargo or Countrywide. I remember who it ended up with. And the second one was with Chase or Bank One. We did that to avoid having to pay private mortgage insurance. Now, with these homes, with the sales price of the homes ranging from $80,000 to $175,000 to make up for that $35,000 to $62,000 income, what do you see about that? Well, those are obviously properties that don't fall into contract for deeds. Those are the ones that are going to be true first liens. All right. So the thing to keep in mind, if you're salivating like I am in some cases, Michigan should be a target state for you over the next 3 to 6 years to buy non-performing debt on it, as long as the values maintain. It's beautiful to see what's happening in Ohio, happening in Michigan with the values come back, Indiana with job growth, things like that, Illinois. That's great. Appreciation goes up, but it can't keep going up, everybody. It's got to either level off or start taking a dip. And I see these things. Yes, I get excited. But on the other hand, I just shake my head. It is the beginnings of the Big Bang or the Big Short all over again. Okay. Questions, comments from anybody? You got quite a few people watching. It looks like joining's on it. So I always like to say it's like release the Kraken. When lenders start to do things like this, it's releasing the Kraken to go thing. So with these kind of loans, though, you're not going to be buying directly from a hedge fund later on. You're probably going to be buying directly from a bank. Okay. And how do you make those type of contacts with banks? Well, you can use some of the basic things like LinkedIn or a Lane Guide for like $150 to track down the asset managers at these lenders. But when you want to figure out what to say or what to do, this is where the importance of really taking a class jumps in. And we've got our upcoming class.
15th and 17th.
Yes, ma'am. December 15th to 17th is the last class of 2017. We've got some great stuff we're going to focus. We're going to focus really heavily on making bank contacts, because we really see that's where the opportunities are going to be in 2018. And for those that don't know, we're almost full on our banking blitzkrieg aspect we talked about last week, where we're basically bringing 20 people in online and providing bank lists for them to call. There is a cost to that. It's not a free service. I think we've just got a couple spots available after looking at some things, but it's $500, 4 weeks of bank phone calls, got to provide call blocks, call lists. At the end, once you've gone through the 4 week, everybody gets a list of all the bank contacts. So it helps everybody out in the long run, especially going into 2018. Now we'll be doing that the later part of January through the middle of February. So 4 weeks of focused bank calls. We're looking for people that can make at least 50 phone calls in a week and follow up on a regular basis. If you're working full time, never done anything, never gone to a workshop, this would be not something for you to do. It would not fit into it, because you're just going to be more of a Achilles heel versus actually being able to go out and make some things happen. So that's one of the things to look forward to for the virtual note buying for dummies. Like I said, it's December 15th through the 17th, a virtual note buying workshop. You can get signed up at weclosenotes.com, and it costs us $6.99 for you and a spouse as well. So we are excited. We'll be doing 4 to 5 workshops in 2018. But it's going to be the first one. We won't have another class till February 9th, 10th, and 11th. It would be the first class in 2018 for our virtual note buying workshop.
And by then you're a month behind. So.
I know. By then you are a month behind already into 2018. Exactly. So with them just rolling these programs out, you're going to have to give it some time before you start seeing things in the default rate. But I'd be willing to bet, I'm a betting man and be willing to bet that the default rates on these are going to start hitting higher than their normal portfolio in 6 to 12 months. But somebody, obviously these institutions, is banking on the fact that they can do a lot more with these lenders, can roll them into their larger portfolios, and get what it is. They're just getting greedy. They're expanding their database. Instead of the $100,000 mortgage, they're expanding it down to the 80. And somebody is getting greedy on that side versus thinking they're rolling the dice, not with their money, but with the bank's money. And obviously the hope if something goes to south, that they can get bailed out or sell these things off faster than they have to be around holding with their hands out trying to get things fixed at the very end. So Questions, comments from anybody out there? Thought we had more comments on this stuff. So, one of the great things to do is if you're looking, let's do something here real fast. 0 down mortgages. And I'll type in Texas because we're in Texas. Texas is always an interesting leader because we do things so fast. All right. 0 down mortgage deals, 0 down mortgage, shop 0 down lendingtree.com, mortgageabc.com. Now, VA loans have I would not say VAs fall into the same kind of category. VAs have very low rates, and they don't usually require monthly mortgage insurance like the USDA's, FHA, or conventional loans. Let's see, 100% financing loans are available in 2017. My Mortgage Insider, golly. Here we go. Down payment assistance programs. The Texas, My First Texas Home. All right, bankrate.com. So it's not just in Michigan. You're starting to see stuff all across the country. So if I was planning for 2018, I would be, which we will be start doing this, just coming to the top of my head. We're going to be making a list of the lenders that are offering this 100% financing, the 0% down payment, and be something that we follow up with in 6 to 12 months. This is how you build a platform. This is how you build a pipeline of deals for you in the future. It's not just right now. It's following up with these guys in 6 to 12 months so you have deals in the future. You have deals come mid-May, June, July. Because that's going to happen. A lot of people that have already been getting loans, what's going to happen come December? You're probably going to have some January defaults. Because why? Christmas is coming. I've got to pay for the Xbox and the big screen TV now that we have a house. Or the leather couches. We're going to buy the toys to go with everything we have because we're homeowners now. All right? So you're going to have those default rates that roll into it. I would not be surprised if we see more default rates. Jen's going to have a great time come January 1st with people probably being late on their payments. We've already had a couple people do some stupid, shady things, huh, Jen? Yes. And Jen's over there. Why you got to talk about me? I was having a good day till you said that. So that's the thing. Keep that in mind. Keep those numbers inside. One of the great things to think about, this is why you don't want to do skinny deals at 12 to 18% based on performance of a note. I had somebody reach out to me this morning and said, hey, I'm getting ready to do these deals. It's going to be, they're performing and they're yielding about 12% yield. And I'm like, okay, are you using your own funds? And he's like, no, I'm using other people's money. I'm like, don't do the deal then. Because the deal's only going to return a 12 to 16% yield right now. And your funding partners want half, or they want a 12 or 10% return. It leaves you with basically nothing. So you do all this work not to make any type of return. So don't, for those of you out there that are buying notes or using other people's money, you want to make damn sure that the deals are going to return you at least a 20% yield so that if you've got to split that, you get 10% going to your funding partners and something coming to you. Even a little bit less if you've got to cover a few expenses. Still want to put something in your pocket versus nothing. Don't do a skinny deal. It is not a good thing to do, especially buying at 85, 90% of unpaid balance. There's not a lot of room there if it does go south for you to really make any money. There's enough there for you to get your investors' money paid back, but if it's too skinny a deal, don't do a deal just to do a deal. Be smart. All right? Be smart. Don't do skinny deals. All right? Avoid the crack. All right? These borrowers out there, it's mind-blowing. It's like I'm seeing a rewind. Maybe we're going to have the Big Short Part 2 coming up in 6 years. Who knows what's going to go on with that. But anyway, I mean, don't get me wrong. Michigan and Ohio have done a great job regentrifying the cities. The Gordie Howe Bridge is being built in Detroit. Going over to Canada is a big influx. Downtown Cleveland, downtown Columbus. I've done some big things. Cincinnati, which great looking city, driving through there this weekend. Didn't get hit as heavy as some of the other cities there in Ohio, like Dayton, Akron, things like that, where you've got foreclosures all left and right. But you do have a lot of opportunity. You just got to be careful that you don't take a bite from every pie, because sometimes there is a poison apple sitting out there. Okay? Questions, comments from anybody? Nicole?
Nope, we're good.
We're good. All right. So let's talk about these departments. So what happens when a loan gets originated? Okay, you have mortgage, you have the origination side, and it rolls over to the portfolio side afterwards. Well, but the portfolio side is the special. assets or the secondary marketing department is looking. It's usually their offices, if they're in the same building, they're right next to the pricing desk. And what does the pricing desk do for lenders? A pricing desk is going to look at the programs available out there from the competition and try to adjust their platforms or adjust their qualification, whether it's FICO, down payment, LTV, things like that, to make it the most affordable for what's up. So you have right now, Fifth Thirds, all right, Flagstar Bank, so they're looking at this opportunity as an opportunity that they can tap into in this area around there. Doesn't mean it's a good idea to go ahead and roll those ideas out. Now, it may be a good short-term profitability-wise. If you look at their stock prices probably bumped up a little bit over the last 6 months, risen because they've had this influx of new borrowers coming in, new loans being done. Yes, it puts some money into the market, but what happens when those loans start to go bad? Well, I'm willing to bet that they're planning on having these things sold off, hopefully, before they have to pay the piper. All right. Now, what also happens a lot of times is if you have warehouse lenders who have a warehouse line with United Wholesale Mortgage or Flagstar, whoever, mom and pop mortgage bankers, that if they create these loans and the borrowers go in default in the first 6 to 12 months, they have to buy these loans back. All right. So another opportunity, if you're a note investor, is to find out. I don't know if I should give this away. This is a good deal. This is a good idea. Find out if they have any warehouse lenders, if they have a warehouse line manager for any other mortgage bankers. I guarantee they probably do. And so that's a great opportunity, talking to the person in charge of the warehouse lines, because a person who's in charge of, like, say, Flagstar's warehouse line may deal, let's say, with 20 mortgage bankers or 20 or 100 mom and pop mortgage bankers across the state or country and things like that who are making individual loans that Flagstar is buying off their lines. Well, the minute these people go in default in 6 months, the mortgage banker may have to buy that loan back from Flagstar at full value. Well, if they're in default already, they're already losing 5, 10, 15% off the face value of that loan. So they may have to buy it back, and it's worth less than what they owe. It may be worth 80, 85, 90 cents on the dollar than what they into it. So now they're motivated to get this off their line because that's a loan that they can't lend out once a month on. So they may take another 10% write-off just to get it off their books to somebody else who will pay 75, 80 cents on the dollar for it, because they can turn around and recycle that money, 6 to 12 times a year and make up for the lost fees. Okay? Doesn't mean it's a bad loan if they're not default. But if they are in default, I would not be looking to buy that loan. I would let it sit there for 3 more months right on their line until somebody's a lot more motivated to take it down, because we've had success with that with mortgage bankers in the past. This is why I can't tell you. I don't have a crystal ball, all right? But I see things happening again all over it, like in 2007, 2006, 2005, things leading up to where it was in 2008, 2009, because the magic and the music stopped on a dime with a lot of stuff. So stay tuned for more craziness. We might even see the mortgage imploder come back.
What?
Yes. For those that don't know, there was a website out there, and it might still be around, the Implodometer, which tracked, let me see if it's even up still, mortgage Implodometer. Oh, here we go. Mortgage Lender Implodometer. This was a website. Oh, okay. Looks like it's still up. mi-implode.com. ML-implode. You can go and post it there. So like mortgage lender, ml-implode.com. You put it in the comments or on Facebook. So this tallied the mortgage. I don't think it's being up to date very, very much for the most part. I'm trying to see if there's anything in here. Yeah, some of these things are like 45. I don't think it's really being updated anymore. But this little website that would track lenders that were going out of business, okay, that were imploding. And it literally gave a list of all these lenders down at the bottom. And I want to say Flagstar was on this list originally. Let me see if I could find it here. Because a lot of these lenders I bought loans from before they went out of business, or I bought from the corresponding bank that bought them. Yeah, ML implode. You got it? But since they haven't updated. They stopped watching this because it slowed down some. It's so crazy. There's not search engine. Here we go. Search, and we'll just say Flagstar. And the website for those that are listening on iTunes is ml-implode.com. Okay. No, it doesn't. I'd have to take a look by downloading the whole list again and taking a look at it. But it's an interesting website. It was one of the great things that we used to focus on a little bit when I was teaching, because there was so much stuff going out of business. There's so many, and it tracked international banks. It tracked who went out of business and who came back. I wonder if I can do a quick copy paste over here. Oh, I can. All right. I think Flagstar was on this, or Flagstar Wholesale was on this list originally, which is a branch of it. Because you had some, I won't let me do it. But anyway, what I'm trying to get at is you start to see some names reappearing on this. Like, you start seeing banks rebrand themselves a little bit once they've had to kill off one entity to bring another one back, just as they start diving into it. Okay. HSB Mortgage Services, I see them on here. It's funny. Some of these banks I haven't seen in years because we bought from them and then they went out of business. Wow. Yeah. Summit Mortgage bought from them. Wow. It's if you don't think that there is defaulted paper on the market that you could only buy from hedge funds or lists like DebtX or auction.com, you are sadly mistaken, everybody. There is a lot of paper still floating out there, and there's going to be more of it coming. These articles are proof of it just in itself. Any questions from anybody out there? Colonial. Oh, wait, that's a different one. It says Colonial National Mortgage. Like, is that Colonial out of Dallas? Eddie Speed's group? No, it's not. But what was so great about this, they gave a watch list of lenders. Like Bayview Lending Group was on there. Bayview out of Florida. Oh, there it is. Aileen, Flagstar Bank Corp. There it is. It was on the Aileen watch list back in the day. So that's the thing. Nation Star went out of business, was back. JB Nutter went out of business, and they're back. Wells Fargo Canada went out of business in Canada. It's so interesting looking at this stuff. Apex Lending, wow. AmTrust, wow. There's just some names on here that bring back some memories of some stuff. So, but there's not really any questions, guys. That's the biggest thing I can tell you. To take advantage of what's happening right now, you got to prepare yourselves for 6 months from now, or 3 months from now, or the first year. And what's the best way to do that? Is understand where this product is going to be and how to reach these individuals at a later date. That's some of the things we're preparing for 2018. Is I would not be surprised if we full tilt go back to, because this year it's been basically 75% hedge fund loans and little on the bank side. Probably more 80, 85 from the hedge fund side this year and a little on the banking side. But this is going to be one of the focuses of the mastermind that we have in 2 weeks, is how to prepare for 2018 and some of the economic trends that we're seeing and lenders that we're starting to see that are really, really setting the stage for that first domino to start falling, or a big bad wolf to come by and huff and puff and blow that house of cards down. So, like I said, guys, if you want to find more information out about our upcoming workshop, it's December 15th to the 17th. If you're listening to this on iTunes, hey, drop me an email. We're glad to send you over a link for it to get you signed up one way or another. But once again, thank you so much. We went over the 35,000 downloads, which is exciting. Not even 90 days into it. Rock and roll along. Thank you so much. Please, if you love what you hear, I want to thank all the emails that people send out to me. As always, you can send me an email at scott@thenoteclosershow.com. That's my email just for the podcast. Make sure to leave a review in iTunes or Stitcher. Love for you to share the episodes too if it's something you enjoy. If it's helped you in any way, please do so. And we look forward to continuing to expand. Now, we've got some great guests lined up here over the next couple of weeks. You're going to definitely see some fun stuff. We got trying to finalize a guest for tomorrow as well. So hopefully we can get them scheduled in. We'll get rocking along. So otherwise, guys, go out and have a great, today's Tuesday. Go out and make something happen. And we'll see you at the top. Bye, everybody.